But here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973 after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. It morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young up-and-coming lawyer at Citibank and a senior officer living in New York City, and that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. Again, we got the first thing. We're not quite there with the second thing yet, but we probably will, partly because the Fed is so far behind the curve. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You're talking about 40% on credit cards in that world. And people forget, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were three recessions between 1974 and 1982. We had three: 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. That's why gold went to $800 an ounce from 35 to 2,700% increase. And in the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were. We're getting back to something like that. The government doesn't want to bail out anybody, but since they don't know what they're doing, they end up bailing out people. No one's less prepared for this than Janet Yellen. I mean, she's basically a labor economist, statistics geek. She doesn't really understand what we're talking about. But what happened in 1998? Everyone's like, long-term capital lost all this money in Russia. That's not true. We lost 100 million in Russia, but we lost 4 billion overall. Russia was a catalyst that caused a global financial crisis that spun out of control, that caused the losses. And we had 106 different positions. So, you're 106 position, and you're like, well, yeah, some of them are going to make money, some of them are going to lose money, but how could they all lose money at the same time? How is that even possible? Well, the answer is that in a normal degree distribution, normal markets, even kind of edgy markets, they're not correlated, but there's something called conditional correlation, which is something extreme happens and everything correlates at once. They all go down together. And that's what happened. So Russia was the catalyst for that. August 17th, 1998, they devalued the ruble and defaulted on their debt. The company that lost the most money was actually Credit Suisse. But it didn't matter what your Russian losses were. What that did is that started a global financial crisis. The best description of which I've ever heard is everybody wants their money back. It doesn't matter what the trade is, what the spread is, what the arbitrage is. Everybody wants their money back. And so everyone's deleveraging and getting out of their balance sheet so that all the spreads are widening, all the positions are losing money. And then it ended up in our lap. When we called the Fed in kind of mid-September, we didn't think we were going to get bailed out. We weren't asking for a bailout. We knew what was going on. We just called them like good corporate citizens. We're like, hey, we want you to know what's going on. We see it to like 2 decimal places. This is a disaster. It's going to get a lot worse. We thought you ought to know, but we didn't ask for anything. We didn't expect it. But when they came up, Peter Fisher and actually Gary Gensler, who's now the head of the SEC, came up. We spent a day going through the books. Their faces were white. I mean, they were just like pale. Like we knew you guys would take down the bond market, but we didn't know that you would close every stock market in the world because we had $15 billion of risk arb positions on. And so that's when the bailout talks began, and we got through that. So we brought it in for a soft landing. But, if you're younger than like 40, you've never heard of it. And if you're younger than 60, you might maybe recall it a little bit, but not really. But that's what happened. The thing is, the same thing is happening again. Russia is being forced into a default. We've thrown everything we have at them. These are the most severe, the Treasury has said this and the White House has said this, and they're right. These are the most severe, most extreme, most comprehensive economic sanctions ever imposed. And there's nothing new about the economy and warfare, kinetic warfare, sort of combining in certain ways. So there are unintended consequences, unforeseen effects, but again, nothing new about economics and warfare. But this is different in a couple of respects. Number one, these sanctions are, as I say, broader, more comprehensive than ever. But U.S. citizens are going to end up paying a much higher price than Russian citizens. And Russian citizens are paying a price. There's no question about it. But you have to ask yourself, other than kind of a feel-good aspect, what are the sanctions designed to do? Well, punish Russia. Okay, well, that's punishing the Russian people. I'm not sure you're punishing Vladimir Putin or the Russian general staff, but it has not changed the behavior on the battlefield one bit in terms of changing shaping the battle on the ground and in the air. But they have decimated supply chains and will possibly create a global recession. So extremely costly, ineffective in the sense that they don't change behavior on the battlefield. And worst of all, it's sort of, if you're Russia, and it's not just Russia, China, Iran, Turkey, Kazakhstan, Saudi Arabia, Riyadh, Dubai, they're all looking at this and saying, is this all you got? And the answer is yeah, because it's hard to know what more we could do. We've frozen accounts, kicked them out of SWIFT, kicked them out of the payment system, stopped, exports of energy, at least on a forward basis, frozen their accounts, made it possible for them to pay bondholders, et cetera. Well, now, ever since 1998, Russia spent all their time and effort building up the reserves, and very successfully. They have $600 billion in reserves, of which about $150 billion, or 20%, is in gold bullion. And then, the rest in, government securities and other liquid instruments, some yuan actually in there. So they can pay their bills with ease, but they're not being allowed to. This is a default where the creditors force them into default. When does that happen? The debtor goes into default, that happens, but when does the creditor say, you can't pay me? By the way, what happens when you tell Russia they can't pay their bondholders? They've got about $50 billion of dollar-denominated government debt. It's not a lot relative to their GDP, but it's a big number, and a lot of dollar-denominated corporate debt. When you tell the debtor they can't pay, who gets hurt? It's not the debtor, it's the creditor. So you have to ask yourself, well, who owns the Russian bonds? The answer is BlackRock has a lot, but you might have them in your 401k. Did anyone buy, a developing economy, emerging markets ETF from Morgan Stanley? I don't mean to pick on Morgan Stanley; it's a good firm, but look at the offering document, get the account statement, look at the fine print. Probably some Russian bonds in there somewhere. So the cost is borne by the bondholders, by the creditors, which are U.S. citizens and U.S. funds, investment funds and wealth managers, et cetera, not by the debtor. They get to, skip the payment and save the money. So lots of unintended effects, lots of boomerang effects where we actually lose. The point is, this shows you it is a complex system. It is densely connected. You can predict a catastrophe, but you don't know exactly where and when. That's how these things roll. The Treasury doesn't understand it. I warned them about it for a long time. They don't listen. Fed doesn't understand it, but it happens. And so I wouldn't rule out the fact that we're playing with fire.